How much has the money that you're talking about, which is coming from different sources than traditionally, basically been the reason why we haven't seen the credit cycle that so many people were expecting?
Well, I think it's a very interesting question. I think what's going on right now, and I know you had Torsten here yesterday, is, last year you had the equity markets up 20-something%, broadly speaking. And at the end of the year, you had defaults approaching almost 5%. That's a pretty unique characteristic. Usually when you see defaults rising like that, you have a declining economy. The strength of this economy has befuddled economists and all your guests for the decade. And if you look at where all the dot plots have been, even those folks who have all the information have missed this. Now, I think once we all say that there's not going to be a cycle, I do think you are seeing some signs of a hardening of economic conditions that are finally coming up. We'll see it in the next few weeks. I think the Fed's made the right choice. I think I talked several months ago here about the Fed put us back. They put themselves in a really interesting position right now where they can mute volatility with having a lot of bullets left in that gun. But I do think there's a modern economy that's going on right now. The depth and breadth has surprised economists and guests across the board. And it's a much more resilient economy. The U.S. economy is the bulwark of the Western world right now. It really is.
Economy's strong, and I think you told us before Christmas, basically the Federal Reserve has the space now because of lower inflation to respond to negative shocks. What I'm trying to work out, though, of the issuance that we've seen so far, and this is more in public markets where Lisa and I have been talking about this boom in supply to start this year and this flood of demand, is that because the economy's strong, or are we just anticipating lower rates this year? Which one is it?
I think it's a combination of, the U.S. consumer has prepared themselves very well for a higher rate environment. Corporate balance sheets have prepared themselves very well for a balance sheet. And when people see financing opportunities, they know now that, don't wait around for perfection. And I think that's been a good lesson. Don't let perfect get in the enemy of progress. And I think there's been a very, very thoughtful, there's no doubt there is, when people see what's going on where rates were supposed to be going, there has been a rush, and there is a risk-on trade right now in virtually every asset class. The market has priced to perfection in virtually every asset class, and that means it's a good time to issue. I'll tell you, for us, we typically underperform in periods like this. We have a lot of cash on the balance sheet at Athene right now. We're very low levered. We've put ourselves in a position, if there are pockets of volatility, we're going to be well positioned. But that's how we prudently, when we have a macro view, that's how we express it.
It's a classic approach. You want to be the liquidity provider in times of stress. It makes perfect sense.
And I think the story that really has not been spent a lot more time on, this issue of market structure, the rise of passive, the lack of companies' ability to really do, the equity market is, and the equity IPO market is fundamentally challenged. And I know SPACs were not the answer, but in our view, that this market structure issue has been going on for several years. It's going on for a decade. And the advent of passive in scale, now more than 50%, I think that's going to have profound implications on how companies raise capital going forward.
We've got time to work through that, through the ad, because luckily you're going to stay with us. You mentioned credit stress. In fact, that's my word. I can't remember the word you used precisely, but I do want to ask you about that. Are you seeing pockets of stress right now? NYCB, commercial real estate, we talked about it for the best part of 5 minutes, market moves on. What are you seeing?
I think you are seeing, in a very broad growing economy with massive fundamental strength, you're seeing some situations where companies either poor business plan or way too much debt and have not maybe recovered from the COVID crisis. You're seeing that a little bit more in the corporate world. In the U.S., the U.S. consumer, the average mortgage is 3.8%. We've not seen the pain that's been seen in the U.K. and Germany. That's really protective. So you're seeing some signs of challenge and weakness, but there's been a tremendous amount of private equity activity and financing activity the last 5 to 7 years. So the fact that you're going to have some stray challenges around the edges, interesting. I don't think it's a macro telltale sign of things changing. But there are challenges out there, no doubt.